Raunak Onkar is joining us now today from Parag Financial AMC to talk more about markets and the fund which he's managing. The markets are slightly off highs right now. So Raunak, I was looking at your fund breakup. You have 65% in Indian equity, 35 outside of India. So which part is more, richly valued and which part is more attractively valued right now? Global equities or Indian equities?
So Ajay, first of all, thank you for having me. I'd just like to make one correction. At the moment, we don't have 35% invested. That is the maximum limit for foreign investments. We are currently at around 17% invested in foreign stocks and around 66% invested in domestic stocks. So we are finding both markets to be interesting. Some companies we like, fortunately, are trading at reasonable valuations. So we are able to add to them both internationally as well as in the. However, there are many pockets in our market as well as global markets. They have become a little expensive and we are trading cautiously because of that. Hence, we have around 16% of cash in the Flexi Cap fund.
Right. So, Raunak, I want to understand the impact of cost of capital on your portfolio from here on. We've seen very sharp interest rate hikes in US, where you have bulk of your overseas portfolio in the last 18-20 months. The rise has not been that sharp in India. But if we assume that in the next 6 to 8 months, the direction of the rates may actually reverse, give or take a quarter, how will that reducing cost of capital impact your blended portfolio?
Sure. Speaking specifically about the international stocks, so interestingly, the cost of capital really hurts those businesses who constantly need to depend on outside capital to raise money and to scale their businesses. Fortunately, the companies that are there in our portfolio were selected on the basis of having a very strong cash generation from their existing businesses. So they don't need to go to the market periodically, debt or equity markets periodically, to raise money to fund their expenses or fund their future prospects. So these companies have their own cash and they haven't been as dramatically affected by the rising interest rates. But overall, the funding environment is affected. So if these companies would have customers who are dependent on raising equity capital or debt capital, they would definitely be affected over the medium term. But that will be a part of their diversified customer approach. So they will have to the companies will have to manage their customer diversification wisely so as not to get affected too much. But intrinsically, they won't be affected as much because they don't need to dip into the capital markets periodically.
I'm assuming more technology-oriented names are there. But what I meant was also, even if they don't need to raise capital directly, indirectly, but the ecosystem will actually, yes. They will be benefit from, because growth stocks are valued better in a interest rate scenario which is actually coming down or actually already started. What's the kind of outlook right now when you talk to most of your portfolio companies in India? I was looking at, you have bulk of your names in the BSE 200, the largest mid to the large cap. When you talk to them, because the business survey, the CII Business Confidence Survey, which is just released on Saturday, seemed to be suggesting reading of 66 versus 64. So that is pointing higher. What are your feedback and the kind of interactions you're having with the top companies?
So if you see, most of the companies in the domestic side have come out with their annual reports and have released their financial year ending numbers for FY23. So if you look at the commentary from most of these companies, they have had a good run, many of them, in the past 2 to 3 years. And this is because especially the COVID created a lot of disruption and the pullback was so strong that most companies delivered good volume growth and good business growth in many areas. So that was a great thing to see. But when you look at a longer term trend, we have to always see minus the disruption. So if pre-COVID versus current numbers are doing okay, then they are on a good trajectory on how their businesses are going to grow. However, you have to also keep in mind that overall corporate capex has not picked up as people had anticipated. In many cases, the only capex that is happening is on the public sector side. So many of the public sector companies have also done well, considering they have also had the benefit of the cycle turning in their favor.
I see a lot of commodity user companies as well in your portfolios, be it manufacturing, autos, and many others. what are your thoughts on the margin profile of commodity user companies next 4 to 6 quarters, assuming that the worst of the commodity rally and hence the margin pressure may, do you have a number in place or have you worked around it that what kind of improvement can we expect going forward?
We don't take too much of a short cycle to understand these raw material impacts on these companies. We generally look at longer term trends as to how they have weathered over a period of time, no matter what the cycle has been. Every cycle will create opportunity for incumbents or create disadvantage for incumbents. So we have to track them over a longer period of time. And so far, margins have been stable. So they have not dramatically deviated from their longer term averages.
Raunak, in technology, I want to understand from you a little more. Both US technology and Indian technology companies catering to a lot of BFSI, retailers and many other sectors globally. I was talking to, Ed Yardini just a while back, half an hour back, of Yardini Research, and he was sharing a contra call that US economy is actually witnessing a very subtle kind of a recovery. It may be not very prominent right now, and the chances of a soft landing are only increasing. It may not be a hard landing. If indeed that happens, the demand environment for many of the technology companies may actually improve. Is that a right way of looking at things? How are you looking at the demand environment part of technology?
So one part is obviously demand environment matters in the longer run for these companies to consistently grow their markets and grow their business. What we focus mostly on is individually how each companies are placed in whichever segments they are operating in. So for example, if we talk about cloud computing players, do we see cloud computing demand consistent over the longer term for all these players? If the answer is yes, then it makes sense to stay invested in that segment. Digital advertising is a category which has seen a great growth rate after COVID, but it seems like it has stagnated because of the high base just immediately after COVID. But if you see, digital advertising trends are still trending towards more digital ads rather than traditional media. So those trends are also working in the favor. So if these companies are going to benefit meaningfully from those trends, then we think it's a great place to be in. Similarly, enterprise software or online retail, if you see more and more people consuming enterprise software, more and more enterprises now becoming digitally savvy, and even consumers are spending more online versus spending more offline as a relative scale, then I think all these trends work in favor for some of the companies we own. So we look at them individually from their sector exposure and see if they are doing okay in that, rather than working backwards from saying what the demand will be in the next 6 months or a year. It's better to look at them over a long period of time and see how they are performing in their own segments.
What's your positioning on power sector? I see a lot of power related names also in your portfolio, and these are not very often discussed, but if you look at the fundamentals of the power sector in India, there's a lot of reform work happening, smart metering, aiming to plug the gaps. Power generation too, on the other hand, has been at record levels. Do you see power sector offering good opportunities, be it the generation side, distribution, or even financiers over the next few years in India?
So there are 4 segments in power sector in India. If you think 5, if you take the exchanges also. One is the raw material, which is the coal or natural gas there, those companies. Second is the power generating companies. Third is the power transmission companies like Power Grid, etc. And fourth is the next is the exchanges who facilitate trading in power. So in our portfolio, we own Coal India, we own Power Grid, and we own IEX, the power exchange. But we don't own the generators yet. So our outlook has been that wherever the opportunity is interesting in terms of cash flows and volume pickup, and over a period of time, we are also getting a good dividend yield cushion, we have participated in those opportunities. And with IEX, it's a different play where we bet on the network effect of an exchange, which has the dominant market share, and looking forward to see how they evolve in the power exchange category, because we are a very nascent market compared to developed markets in the world. So there is definitely long-term opportunities, but we have not participated in the generation or the capital goods side of power business yet.
Raunak, good chatting. Thanks so much for your time this afternoon. That was Raunak Onkar of Parak Financials AMC talking about his FlexiCap fund and the ingredients which are making it